So, folks, here is part 3, and we're still talking about tax credits, and we are going to look at the earned income credit. This is one of the more complicated in calculating. It's very common. It is refundable for the most part. Can be as long as you qualify. Based on your filing status, number of qualifying children, and there is available credit for those without children, but it's much reduced compared to those with children. So it's it's based on earned income. So basically the idea is, as your earned income goes up, if you start at 0 and your earned income goes up, the amount of the credit is also going to go up. And because when it's really low, it's actually your credit is also low. But as you go up, the credit itself gets higher and higher until it reaches a point, and then it starts to go down the other way. It starts to reduce as your income continues to go up. So you might say there's kind of a sweet spot in between there where it's the maximum earned income credit. So what do we talk about? Earned income, wages, salaries, tips, earnings from business, the stuff we talked about earlier in chapter 6 in terms of self-employment income or income from pass-through entities, that sort of thing. You have to, at some point it phases out entirely, meaning that there's no credit, and you have to have, like I said, earned income, but you can't have too much of unearned income either. Like we see in the next slide, if your investment income, interest, dividends is in excess of $3,600, you're ineligible. Okay, so you have to have some earned income. If you have 0, if you report 0, you get 0 credit. And so that's how it works. Now, most people, this is how it's calculated. You got maximum amounts, you've got phase outs, all that kind of stuff. But almost everybody looks it up on the earned income credit tables. Your authors or this textbook does not provide those tables. They are easily found on the IRS website. But you look on those tables, make sure you're not looking at tax tables, make sure you're looking at the earned income credit tables. And you look up the table, you look up your income twice. You look up the AGI and you look up the earned income. Now, for most people, it's very much the same. It should not be a big difference. So most people's income is mostly earned. But if there was interest, it would be included in the AGI calculation, but not in the earned income calculation. You look it up twice and you take the lower of the 2 credits. So when you look it up on the credit, just like tax tables though, and this is why you can sometimes get them confused, it's in columns based on filings, the number of children you have. Okay, so you have no children, 1 child, 2, and then 2 or more. 3 or more, I should say, on the table. So it looks kind of like, it does kind of look like a tax table. So you look it up the table, AGI, then you look it up on the table with your earned income, you take the lower of the 2. So most people do that rather than trying to do all the phase outs and the different calculations, which is somewhat involved. Okay, so last credit, premium tax credit. This idea is this is a credit to help you pay for your healthcare premiums that are required or were required. So the responsibility payment was covered in chapter 1. We really didn't cover it because it's 0 for 2019. I mean, it still exists in the tax law, but the amount of it is 0 for 2019. But they can have a credit. It's for people with income between 100% and 400% of the federal poverty level. for your applicable family size. So it depends on the size of your family and so forth. So this is also fairly involved. So you're comparing how much you paid for health insurance or how much the plan that you could have chosen costs compared to what you should have paid based on your income. So there's this calculation that goes in this steps. You first take your income, you'll see where it compares to the federal poverty level based on your size of your family. That tells you, based on where your income is, what percentage of your income that you should pay towards health care or health insurance. Once you know that percentage, then that's how, you multiply that by your income. That's how much you should have paid for health insurance, or at least that's how much the government thinks you could afford. Then you compare that to what your plan either costs or the premium for the lowest cost silver plan. You compare those, and the difference is what you should get as a tax credit. Basically, you're saying, okay, you paid more than you can afford, therefore you get some of your taxes back that you paid in income tax. And this is a non-refundable tax. Tax credit. So it is not going to result in a refund. I misspoke. This is a refundable credit. It does get refunded even if you don't have a tax liability. So remember that correction. All right. So that should be all the credits. Well, that's not all the credits. That's the ones that you're going to see most of the time. There's all kinds of other credits, but that we will not cover in detail in this chapter.